Mhm.
Like it doesn't matter if a deal is showing 120% return in 5 years on a PDF pitch deck. Means nothing.
Yeah.
What you have to combo with that is like, what are they using to get those numbers, right? What are the assumptions? So if they're assuming the asset is going to be occupied at 95%, that's a little high. Normally 92% is assumed full occupancy.
Welcome to the Generations of Wealth show. I'm your host, Derek Dombeck. And once again, we have found an incredible guest. I know you're not shocked because all of our guests are incredible, but all the way from Hawaii, and we recorded this when it was pretty early in the morning for this gentleman. But Lane Kawaoka is with us, and Lane's journey has been really, really impressive, right? He started just like many start with just a single house, going into a duplex, some other single family properties, and then grew into the world of syndication and has at this point done well over 10,000 units that he's been involved in, and just so much information. He's got what he calls the wealth elevator, and that's how he kind of took his journey. So that's what we're going to talk about. Before I bring Lane on, um, I try to say this on every show too. We appreciate you, and let me help you. Anything that I can do, don't hesitate to reach out. That is what the Generations of Wealth family is all about. So jump on the website, go to derekdombeck.com, shoot me an email, derek at globalgow.com, whatever it is. And, let us help you and grow your network too. So, with that said, let's bring on our guest. And once again, with an incredible guest, Mr. Lane Kawaoka, all the way from Hawaii. How are you this morning, sir?
Hey, I'm doing great. Aloha, everybody. Thanks for having me, Derek.
I know we were just chatting a little bit before we started recording, and you're getting your coffee in you, you're getting your caffeine in you. It's a lot earlier there than it is where I am. So I really appreciate you, taking the time out of your morning to chat with us.
Yeah, it's kind of the bad thing about living here in Hawaii when we wake up always to a inbox full of emails and playing catch up a little bit. But
Yeah,
you guys seem to shut it off by my noontime, it seems like, so I can actually get work done without emails coming in the inbox at that point of the day.
nice. Well, you're gonna get no sympathy from me or probably any of the listeners when you get to live in paradise, and we deal with snow and cold and all that fun stuff. So, um, well, let's just start off. Tell us a little bit about yourself and your background, and then I want to dive into our topic, which is what you call the wealth elevator.
Yeah, so I guess maybe I'll start, you know, probably not very much different from most investors. I was kind of taught to go to school, study hard. Eventually became an engineer, graduated from the University of Washington up in Seattle. And I'll call this the linear path where, that we were taught to be a good citizen, work a good job, um, and also buy a house to live in. So that's what I did. A couple years out of college, I saved up 80 grand to go buy a house in Seattle. I think it was like 350 at the time, so $80,000 down
Mhm.
payment. And because that's what I was brainwashed to do, buy a house to live in, which I don't necessarily think is a good idea for some investors out there. And do the whole 401k thing.
Mhm.
Um, at this time, I was working as a construction supervisor, traveling all over for work, never home. So I was in my early 20s and I was just like, well, this is a little silly. I'm only here on Saturday. Why don't I just rent this thing out and just be semi-homeless? So I wasn't homeless. I was living in the company,
Yeah.
hotels, and just kind of on travels and expenses all the time. But this is where two things happen. I got the aha moment for like rental real estate. And I was like, wow, if I keep doing this, I'll be able to quit the rat race and also turbocharge my savings. So I think before this, when I was renting, or had a mortgage, I probably saved 30, 40 grand per year. But when I did this, lived off the company dime, 100% expenses, I probably pushed my annual savings to 100 grand
Mm.
per year. And, doing that for 5, 6 years, putting it all into real estate, eventually bought a duplex in Seattle the next couple of years. So I bought the first one in 2009, and then 2011 bought another duplex. And then then I started to understand about rent to value ratios. Seattle's a very high priced area. Started to buy properties in Birmingham, Atlanta, Indianapolis. So in 2015, I had 11 of these rental properties. Later I went to larger syndications and private placements, but that was kind of my early days trajectory.
And when you were doing that in the early days, you're buying stuff remote. I'm assuming paying management companies. Did you go out to those areas to look at the properties, or was it? I mean, because that was really when virtual was just kind of starting, back in 2010, 11, 12. It's much easier to do virtual investing now than it was back then. How did you handle that?
Yeah, I mean, I was working my full-time engineering job, which was my biggest, took a lot of my time. So I would hire third-party property managers in each of these locations. I think I paid them like that 10%, and then maybe half of the first month's rent. That was kind of the standard property management fees.
Mhm.
I would buy pretty much turnkey. I know a lot of people are into that buy, rent, rehab, repair. No, didn't do any of that.
Yeah.
Didn't do any of that. I think that's great if you don't have too much money and you need to kind of create value out of nothing, but didn't do that.
Hmm.
Was too lazy. Didn't want to take on as much risk, right? I mean, especially being remote, because you hear a lot of these contractors, they might help you with a property or two like that, but once they get lazy or something happens in their life, money starts disappearing on those, and you
Yeah.
can't really verify the construction. And to your other point there, I didn't really visit a lot of these properties initially.
Hmm.
So it was really nice to somewhat rely on the bank's appraisal, um, verifying what I was buying out in these locations. So a lot of it was that with, the Fannie Mae, Freddie Mac 20% down payment, um, non-owner occupied type of financing. But yeah, just kind of rinse, wash, repeat. Did the same thing from 2009 to 2015.
Okay.
Yeah.
So what happened after 2015? You mentioned started doing more in syndications or other things like what how did that start?
Yeah, I mean, what does any semi-smart guy do? The single family thing is working, and I've been doing it a while, and I'm like, well, why not do multifamily, right? It's kind of a logical progression.
Mhm.
So I started to, get more involved and started to meet other people, started to travel a lot, started to pay for a lot of these mentorship groups out there. The ones you pay 30 grand, 50 grand for. I would join a few of them.
Mhm.
I didn't really, wasn't married at the time, so I could just do whatever with some of my side money, and it made sense at the time, right? I was in my early 20s. I was, well, not in my early 20s, but I was in my 20s, early 30s,
Mhm.
so it made sense to kind of, put money into myself and learn a little bit more, because I knew that the single family homes wasn't the way to do it. I mean, I think that's a great way, when you're a non-accredited investor, to build your network. And that's exactly what I did. But to give anybody any type of insight, with more than a rental to, with 11 rental properties, sure, I had nice cash flow coming in every month, maybe a few grand, a couple hundred, few $100s per property, right? With 11 properties. But man, was it a little bit up and down, right? Like with 11 rental properties, maybe I had an eviction once or twice a year, some kind of big catastrophe that happened every quarter, like a flood in the basement. Not a huge deal, but and then the property managers are taking care of all that type of stuff. But quickly realized that, hey man, this just is not scalable.
Mhm.
Most of my clients today aspire to $10,000 of passive cash flow. I had maybe a few grand with 11 of them. So you got to multiply that exception rate by 3 or 4. So now you're talking about an eviction every month or two, and some kind of big catastrophe happening every couple weeks. And you can see how this quickly becomes a full-time job, and the legal liability, right? And this is kind of where I started to meet other investors that were accredited and had done what I did, right? Buy a handful of rental properties or more. And we were all accredited investors, net worth $1 million or greater, or make over $250,000 a year, essentially. Um, and when you're in that category, legal liability is a huge thing, right? You're actually a target to getting sued. Nobody really wants to sue you when you don't really got much to grab there.
Right.
Um, and then the scalability, and why did we all get into this in the first place, right? So we can do what we want when we want, as opposed to being tied down to these 30 rental properties where something's crazy happening every other week on that. And then like, I think the big thing for me was like these huge repair bills when you inevitably have a tenant, have go through a hard turnover. Like I said, with 11 rental properties, maybe had only a couple a year, but I would say out of every 3 eviction, so if you do the math, of every 18 months, probably have 1 out of 3 evictions end up to be a big drama where the sheriff comes, throws their stuff out on the streets, because they're evicting them, and then they screw up the property on the way out. On my YouTube channel, I would put up a couple of these like walkthroughs of how these guys just dismantled the house, and I'm left with a $10,000 to $25,000 repair bill and I can't really collect from these guys. These guys are uncollectible.
Right.
So that was kind of what was going on in my head, making the transition to the larger syndications and private placement worlds as a more of an accredited investor.
So how did you start to vet those syndications, right? Because everybody's got the best deal in the world and you're accredited, they want your investment. Um, was it relationship based? Because I know that for us that's huge, right? Our network is really important to us. Vetting deals, letting our friends and colleagues let us know what we're looking for and doing the same for them. What did you do?
Yeah, I mean this is the hard part, right? I think this is where the threshold I was walking through in 2015, 16. I first off, you don't really have access to good operators, right? There's a spectrum of operators out there. If you on the institutional side, you got guys who've done billions of dollars of deals. I wouldn't say you necessarily want to invest with them. They're certainly more reliable, right, and longer track records. But on the institutional side, you have higher fees and splits, where you're not going to get the nice returns that you're looking for. And plus, they're not looking to bring in little investors at $50,000, $100,000 check sizes. They don't want to bring in anybody less than $1 million. Um, that said, when I was coming in, I would get access to the guys on the opposite side of that spectrum, right? Guys who are just getting started. Um, I would say under $1 billion of assets of past deals.
Mhm.
Um, you know, I was just, essentially investing with a lot of new people, right? But that was all I knew. That was all I had access to, right? I didn't have the relationships as you mentioned. So, I mean, what I did is I learned how to underwrite the deals. You take the P&Ls, you take the rent rolls. I had my analyzer, I do into my analyzer. I spot check certain big cells on the spreadsheet, that impact the model, right? I think that's whether you're investing in private equity, real estate, or a single family home, there's always 2 or 3 cells on the spreadsheet that really impact the projected returns at the end of the day. And I think as an investor, you're trying to figure out, or at least what we try and teach our folks is, there are a few things that you can spot check. The operator may not give this to you in the pitch deck. It may not be in there. So you have to ask specifically for these things. But those things to look for are, what is the reversion cap rate used to model out the deal? What is the full occupancy assumptions and economic occupancy assumptions? And then what is the annual rent escalators? And from those three pieces of information, you kind of get a good sense of how aggressively underwritten this deal is.
Mhm.
Like, it doesn't matter if a deal is showing 120% return in 5 years on a PDF pitch deck. Means nothing.
Yeah.
What you have to combo with that is like, what are they using to get those numbers, right? What are the assumptions? So if they're assuming the asset is going to be occupied at 95%, that's a little high. Normally 92% is assumed full occupancy. And then also add on top of that another 3% of economic vacancy. Because if you have 100 people saying, you're probably going to have at least 3 or 4 people not pay, right? Just be deadbeats, essentially. So that's why economic occupancy in the 89-90% range for nicer assets is at least par for the course. But these are the things to look out for.
Mhm.
Annual rent escalators. I'm not going to beat up on Oklahoma City or the state of Oklahoma, but it's not quite of a gusher in terms of growth, right? I don't really want to see an annual rent escalator higher than 1.5 to 2% per year, where that might be okay for a place like Phoenix or Dallas,
Mhm.
right? But I would say these are the things that I kind of learned about and I used as kind of a preliminary stage to kind of look at the deal. And then if the operator was using appropriate type of assumptions, then I would waste time and talk to them. You know, I'm a little bit of an introvert, right? Or maybe I'm just lazy. I don't like to waste my time on a Zoom call with somebody who's just going to tell me everything that I want to hear, especially when they're just a salesman and a firm that's under, $500 million of past deals. But that's kind of where that's where I started, right? And then I would also, the only relationships I had at that time were I knew some of the PPM lawyers, the syndication lawyers, and a little bit of asking around and building my network of other purely passive accredited investors was kind of how I did this initially. That said, I wasn't that great. My first 15 deals I went into, and I would say probably a few of them, so maybe 1 out of 5. You want to look at it as my failure rate, or 4 or 5 was, I think I did well at, but 1 out of 5, you want to be negatively biased, was kind of my failure rate. And I was like, after going into the deal, I was like, probably shouldn't have done that. But hey, like, that's part of investing here, right? Like, you have to take a step into the unknown. You have to like
Yeah.
learn by doing too.
Well, you pay for education one way or another. And most people, even if you learned it from books, YouTube, wherever you got it from, it doesn't always sink in until you actually experience it in real life.
Yeah. Yeah. I mean, I subscribe to the 70-20-10 rule, where 10% is the academic stuff. I mean, we've got books, we've got podcasts, we've got YouTube videos. I encourage people to go consume them, but that's only 10% of the equation. The other 20% is the people, getting people around you who actually do this. Purely passive accredited investors. Problem is, those people aren't at the local real estate club.
No.
They're incredibly hard to find. They're typically in their 50s. Most of our folks are in their 50s. They're not hanging out at a happy hour with some other young people. They're more secretive into their finances and their identities too. But yeah, to your point, 70% of this is actually going out there and doing it. And, hopefully you invest with the right people that don't kind of steal your money. And then you kind of go from there. You eventually get access to better deal flow. That 20%, the network gets better, you get access to better deal flow, and then you just become a better investor. You know kind of what to look for.
Mhm.
Is there preferred equity in this deal? That's kind of pushing up leverage. What kind of debt are they using? You start to learn things. And unfortunately, speaking for myself, you learn things by losing money sometimes, right? Or, going through the peak of the market in 2021 to 2022. We, like everybody else, got hurt too. And, a lot of lesson learned that we take to future deals and underwriting.
Yeah, absolutely. I mean, I started in 2003 and got my ass kicked in 2007, 8, and 9. And, I didn't have a network. I didn't have anybody to call back then. So, but I say publicly on this show and other people's show all the time, like that was a blessing. because it taught me or forced me to learn what I know now. And now I get to help a lot of people because of the stuff that we went through. And that's one of the things I love about this show. I get to talk with people like yourself that in most other cases you and I wouldn't be having a conversation. We wouldn't even have been introduced to each other. So there's reasons for everything, and you do lose money. I had a former business partner used to say all the time, it's a batting average. We need to have more wins than losses, and but you're going to have losses at some point in time, whether
Yeah,
you know
I know you guys have a little bit more of an experienced listener base here. Certainly not what they really talk about to the newbie crowd, right? Because it
no.
scares them away. I get it, right? I mean, it's been impactful to my life, very positively, but yeah, like there are market cycles just like the stock market, just like I mean, crypto seems to go a lot faster market cycles.
Mhm.
But with real estate, especially even commercial real estate, right? Like there's what do they say? Every 6 to 10 years, there's a market correction. So the idea is you got to get after it when the times are good, and you got to take it on the chin in those couple years when it's bad. It always crashes more than it steadily rises. Is typically how things go. It's not an even sine curve both ways in the recovery and the trough. But that's, part of that is understanding where things are relatively to where the value is, or the kind of the rising moving average of 10 years, 20 years, and having the fortitude, right, to go in when fear is high, as Warren Buffett says, when there's fear in the streets, that's when you invest.
Yeah.
And understand that, when times are most fearful, and I believe now the times are the most fearful, right? Especially after a correction. But the value investors know, I mean, especially the people who've been through one or two market corrections, they know that sort of maybe now's the time.
The difference between a good deal and a great one, it usually comes down to what you say and how you say it. That's where Elite Negotiations Academy comes in. We help real estate professionals master the art of negotiation through real-world coaching, live deal analysis, and breakdowns of actual calls. Learn how to control the conversation, build trust faster, and close deals without leaving money on the table. Whether you're talking to sellers, buyers, or lenders, this is the skill that pays for itself. Try it out. $49 per month for your first 3 months. Visit EliteNegotiationsAcademy.com and start negotiating like a pro.
It is nice to go through the corrections and come out the other side without being destroyed, because now you see things more clearly. It's like knowing the punchline to the joke or knowing the end of the movie before the end of the movie. You don't have all the answers, but it's much more clear, and there's opportunities that quite frankly were always there, but you didn't know what to look for, and even if you would have seen it, you wouldn't have taken action. um I think the biggest fear now is getting caught up in shiny object syndrome, because there's more opportunities than you or I should chase. Because in my opinion, if you're chasing too many things, you're not giving any of them 100% of your focus. But I'm assuming you get approached periodically or very often with opportunities, right? And you just gotta have your bullshit meter ready to go. And is this worth the Zoom call, as you said, to even talk about it, or is this just another wishful thinker?
Yeah, exactly. I mean, part of it is, we know what our buy box is as operators, general partners, but maybe the passive investor does not know what they're really looking for, or they're getting started and they just need to kind of diversify too over different business plans. Right now, I think it's safe to say that we've seen a big correction, 20 to 30% off the peaks of a couple of years ago. Some categorize the correction as greater than 2008 in commercial real estate specifically. So in theory, now's the time to buy, right? With prices low. I would say that the biggest there's a two-part of this. Do you do a deal? It's the price, which again, I think now's the time, but it's the loan package. right? Especially if you're doing a longer term hold or more than a year or two, right? Then the interest rate really comes into impact. And more specifically in commercial real estate, it's not so much the interest rate. Sure, the Fed rate and the 10-year treasury drives these loan term packages, but it's the loan to values, right? And still you're seeing the loan to values a lot less than what it was a couple of years ago. And it used to be able to get like 75%. And I'm talking general, right? You know,
Right.
every deal is different, but you know, you're still getting these lower loan to values, maybe even the 50-60% range, and you're not able to make the deal work. The deal doesn't pencil even with the price lower. So that impacts us personally because we like to go in with a strategy of, you know, do some upgrades and you bump the rents up, you know, very modestly, nothing huge.
Mhm.
And we'd like to go into deals where it's not really distressed too, right? Like I think my days when we first got started, we would buy a lot of these Class C smaller properties, you know, but economic occupancy would be like 80%. So 2 out of 10 people were just deadbeats. They just didn't pay.
Yeah.
But that's how Class C is a
Yeah.
lot of times. But I don't really want to do that anymore.
Mhm.
I don't know. Maybe we should. Maybe we should. But like that's just not what we're not swinging at that strike, that pitch anymore, to use a baseball reference. And I think that's kind of where right now, you know, where prices are and where the interest rates are. We're not Nothing's really penciling. You know, sure we could change our strategy, what we swing at, but
Mhm.
um, you know, I think we kind of stay steadfast to those what we're looking for, I guess, for
Well,
now.
at this point, you know, you mentioned banks, and everyone that knows me and listens to my show, I don't use institutional financing for hardly anything. I've always just been a private capital type of person. Not always, but the last 15 years. So, you know, do you like using traditional banks? Is there do's and don'ts when it comes to using traditional banks?
I mean, we use traditional banks. I mean, this is in the commercial real estate world above 50, 100 units. So similarly, and it's a little bit different than residential, but you still have somewhat of the same foundation of Fannie Mae, Freddie Mac back loans, right, from the government.
Mhm.
So any bank or any lender can access these types of loans at good pricing because it is sort of backed by the government. Um, your deal needs to fit in a certain box. Like I said, usually 90% occupied, hit a debt service coverage ratio of 1.25. Um, Now, what we've typically seen is gone after like the smaller banks. So I think we're kind of talking the same thing here. Um, Certainly not going to go after a top 10 bank, that's for sure. But in our world, there's also debt funds. So, and then, you know, other family office or insurance companies will also lend and at similar terms too. Um, I think what's good about the commercial real estate market in the lending world is that it's a pretty it's not a fragmented market. It's a very, you know, you talk to one loan broker, you pretty much got all the loan packages out there. I think it is where single family home residential real estate is a little bit more fragmented in that sense. Um, but you know, sometimes you run into these circumstances, and this has probably happened on a few occasions for us, where you start to get cute with things and you start working with a smaller lender and you don't find out till after you close, maybe a year or two down the road, that you unfortunately invested with a predatory lender, right? Somebody who, you know, the deal's going great and the lender's just being real stickler on the dozens of loan covenants that they set you up with, and they're trying to, in reality, steal the property
Mhm.
from you. So that's kind of where, I mean, that's where having a good loan broker who kind of has the lay of the land, knows which lenders to stay away from, what smaller shops to stay away from. And then also just putting it on your internal, like our internal company blacklist,
Yeah.
if, in a way. But you know, that's a rare occasion, like I said, but it does come up. I mean, on both of those occasions, we just switched lenders and essentially refinance the deal to and now we've kind of got a list of lenders that, you know, in our particular markets that we go to.
Mhm. Well, let's switch gears a little bit. Talk about the wealth elevator. What is it? And you know, it's you've got different floors on the wealth elevator, I'm assuming.
Yeah, so this is the book that I wrote recently. You know, it's made for more of an accredited investor profile. I mean, I get it. There's a lot of books written for, I mean, the first floor of the wealth elevator is the basement, right? So people who make under $50,000 a year don't really have any net worth going on. I think most of the books out there, you know, Dave Ramsey, CZ Orman, a lot of personal finance blog who tells you don't buy a $7 latte, right? They kind of focus on the basement level investors. Like now, you know, going back to my story, I didn't start in the basement. I had a good job. I had some student loans, but essentially I was started on the first floor of the wealth elevator. And, you know, people ask me all the time, you know, should you have gone to commercial real estate right away? I'm like, no, I think you got to go on the first floor first,
Mhm.
somewhat adolescence of investing and pick up some rental properties. And for me, it took a while, right? 2009 to 2015, 16, before I actually came an accredited investor by net worth status. Um, you know, it took a long time, um, especially in the beginning.
Mhm.
And yeah, you know, like so that persona I would say is the non-accredited investor, but you got money, right? But then I think that what we focus in on the book is that transition from the first floor to the second floor of the wealth elevator when you know, now you have something to lose in terms of legal liability. And you get your world gets opened up to accredited investors and accredited only deals, syndications, private placements, and multifamily or any other asset class. Then comes the third level of the wealth elevator, right? When your net worth goes over 2.5, 3 million net worth,
Mhm.
and you now maybe your universe opens up to things outside of real estate. You know, like real estate is how I put myself on the map, essentially, and I did it at a good time, right? Um, but now if you're getting started, I think there's really good deals to be had. But I think one thing macroeconomic wise, the world might change. You know, I'm still a real estate fanboy. Don't get me wrong.
Yeah.
Um, but the days of free money are over, right? If you go look at the Chatham financial curve, they're not predicting that the Fed rate's going to come under 3.5%, maybe in the next decade. You know, we were living in a interest-free, like a 0% Fed rate for a while. Of course, that influences the 10-year treasury, right? Um, which more directly impacts the loan packages for everybody. But we essentially just lost a big trade wind to our back as real estate investors. So it's really kind of, you know, scratched my head. Like we kind of stopped doing deals summer of 2022
Mhm.
because the interest rates just weren't conducive to where the prices were. Now the prices have come down, but still, like I said earlier, still doesn't really work. And we're going to be in this environment. Again, everybody should have the Chatham Financial curve bookmarked. And another resource is the CME Fed tracker too. But long-term forecast is free money is not coming back. Unless there's a war or some kind of big catastrophe, of course, right?
Yeah,
That may
black
be
swan events.
temporarily. Yeah. But that's kind of where, what do you do? Well, maybe you invest in things outside of real estate, right? Like private equity, buying businesses, not entirely, but as a part of your portfolio, especially when you get to that third floor of the wealth elevator or greater. You know, just to put a number out there, maybe 2.5 mil net worth or investable assets. And then later on in the book, we talk about the penthouse level, the wealth elevator, and some of the strategies from there. But yeah, you know, like what I essentially realize is that there's different stages to the wealth building game. There's different paradigms. We live in this world of TikTok and, you know, these shorts.
Mhm.
You know, maybe these are good tips for certain people on certain stages, but they may not apply to you as an accredited investor, say on the second floor. And then, you know, the kind of to wrap up the concept, to me, like my goal for a lot of my folks is to just get them to 4 to 5 million net worth.
Mhm.
Why? Because at that level, you're able to just put it into life insurance or T-bills and live off the remainder for your life. Or give 1 to 2 million to each kid, right? You have 2 kids, whatever. But at that point, you've kind of hit a level that I call end game. You know, and this is kind of where you're on the 3rd, 4th level of the wealth elevator. And that's the idea, is like get to that level as quickly and safely as possible, right? You're gonna have to take on risks for sure.
Mhm.
But once you're to that level, you know, you got to change the tires on the race car a little bit and go into cruise control, because the game kind of changes at that point.
Yeah.
But if you're not even to $1 million net worth, don't listen to what I'm saying. You gotta get going, buddy. Or if you're even to 2.5 million, you still gotta keep going.
What do you think the biggest mistakes are for the people that are under the $1 million net worth? Like, are they playing it safe? Are they trying to do the Susie Orman, save their way to wealth versus invest their way to wealth?
Yeah, I mean, a variety of things, right? Like, I mean, I think we're all brainwashed to buy a house to live in. I think
Yeah.
if you're a good saver, which is probably 1% of the population out there, buying a house to live in is not going to make you as much return on investment than putting it into investment properties, or heck, even go buy S&P 500, right?
Mhm.
Where it makes sense for 99% of the population that should not read my book, you know, they have trouble saving. They need a forced piggy bank. So that's what a house is for them, right? They have to pay their mortgage, right?
Yeah.
A lot of people need that. So it's kind of a, there's always 3 sides of the coin, right? Yes, no, and then the shiny rim on in the middle for the very few. But that's a big common mistake. Another common mistake is, I got to where I'm at with real estate, which is an alternative investment. I think another part of this is investing directly with an operator sponsor, as opposed to investing through a gazillion middlemen, such as through a REIT
Yeah.
or a financial planner selling financial products. So when you cut the middlemen out, you typically get higher returns. It does come in with, now you have to take a little bit more personal responsibility in vetting what deals and people you're working with. So there is inherently more risk. But hey, that's up to the investor to realize if they want to put in the effort into going down that path. But I mean, I had maybe 80-90% of my net worth in alternative investments in my 20s and 30s. And that's kind of got me to where I am at now. And it certainly kicked my ass in 2022 and 2023. I was very concentrated in real estate, and that's where the big commercial real estate correction happened.
Right.
So obviously lessons learned, which is why I'm kind of rounding out my portfolio a little bit more with private equity, things that are outside of real estate a little bit, and life insurance. But these are, I've always kind of been an open book and kind of learn as I go, but be open-minded to kind of new things. But these are things that I think plague the people who aren't accredited. Unfortunately, it's a little difficult, because are these nice, cool syndicated deals, they're not made for non-accredited investors, in my opinion. I mean,
No.
in every deal there's risk, and for somebody to lose 50, 100 grand. I mean, I was there at one time, and I remember watching every month go by, going to a job I didn't like, what it felt like, see it go up by 3, 4 grand every month. Freaking takes you a year to save up 40, 50 grand, right? I mean, I get that. And to see it, just disappear like that, emotionally may not be, a non-accredited investor may not be able to process it. But as they say, if no risk, no risk it, no biscuit, right?
Yeah.
But I think that's what kind of is tough, right? I mean, we have a lot of content on our website for like non-accredited investors to go buy little rental properties, because that's what I used to do. So we just give that out for free. But I think you got to build that base if you're getting started there.
Yeah, definitely. Well, as we kind of start to wind this up, first of all, how do people get the book?
Yeah, they can go on Amazon. And then they can also, if they buy the book, maybe send us the receipt, and then we can, email us at team@thewealthelevator.com. We can give them the PDF version or the MP3 version. I know some people are doing that hack these days where they get both versions and they get the PDF and they put the audio at 3x speed and they go like they just bum rush to the entire book. So I think it's like 200 pages, so it might take you a little bit, but
Yeah.
um, you know, any way we can help people, move a little bit faster. Yeah.
Absolutely. And I guess the last question I ask most of my guests, what's one question I should have asked you that I didn't? And it can be about anything.
I think, from a high level, what's the strategy? I think kind of what's worked for me, and I think which is pretty much the formula on the second floor of the wealth elevator, um, is this kind of trifecta of strategies of investments in alternative investments, real estate, where you're getting good tax benefits and implementing these tax strategies of the wealthy, maybe even real estate professional status too, and then running it through an infinite banking plan. Like this Triforce, this trifecta of strategies is very powerful when you combo them. And this is kind of what I realized, like when I started to interact with all these accredited investors, everybody was kind of doing. Um, but it wasn't anything that the average guy couldn't implement. But it's in some ways the opposite of what we're all taught in a way. Um, but I would say, leave people with the final piece. Like, I think the first step is understanding where you are in this wealth building journey. So, pick up my book. In there, there's like a chart on like, here's basement, first floor, second floor, third floor. You can kind of see where you are. And then I think that self-awareness is important because that dictates what you do. Right. And then I think it also makes sense of the universe out there when you're just bombarded with these random financial tips here or there. What things I do now would certainly not be things I would do in the first floor of the wealth elevator if I was playing my cards right. So it depends on kind of what paradigm, what floor you are in the wealth elevator.
Well, it's awesome insight. And again, we really appreciate you coming on and sharing your journey. I always like talking to people that have been in the business for more than just the last 5 years because, the last 5 years, especially in residential real estate, if you had a house, you made money on it in most cases, but that's not how you build long-term wealth. That's not how you get up to the penthouse. You've got to have a plan in place, and as we said a couple times, there's going to be deals that go bad. There's going to be losses, and you need to be prepared for them. So with that, we'll wind it up. But thank you very much, and you can go on with your morning now over in Hawaii, and the rest of us are into the afternoon for the most part. But again, thank you so much, Lane.
Yeah. Thanks for having me. Thanks, Derek. Bye.
And for everybody else, thanks for being here. Thanks for sharing your time with us as well, and taking the time to also go out and spread the word about the generations of wealth. Anything you can do, I say it on every show. If you know somebody that this specific show is going to help, share it with them, give them the link. And until the next one, thanks and see you then.